DBS Bank is the first Singapore bank out of the three to always be the one to first report the results. DBS earnings was decent and there were surprising results which makes me even more optimistic about banks. So in this video, we will go through their recent earnings results and what are the factors that makes DBS so good. Because of the recent good performance and the increase in their dividends, on the 1-year chart, they are up a good amount of 52%. For dividend shareholders, it's a very good reward with higher capital gains and higher dividends. In the recent results, they have announced the increase in dividends from 54 cents to 60 cents per share. Moreover, they will be giving additional capital dividend of 15 cents per share through the 4 quarters of financial year 2025. This is good because the bonus dividends is spread out through the financial year rather than giving a lump sum, thus having a lower fluctuation in the share price as compared to the previous special dividends. Now let's dive straight into their earnings. Looking at their highlights, for DBS, their full year return on equity is 18%, which is not the best considering the past 2 quarters were above 18%. This meant that this quarter's return on equity is around the 17% range. But do not get me wrong, this ROE is still a very fantastic level for a bank. Total income continues to rise 10% year over year to a new record high of 22.3 billion, mostly due to wealth management and treasury customer sales. With the world uncertainty, I expect more money to still flow into Singapore banks as the banks in Singapore are considered the safe haven. Q4 profit is up 10% year over year, which is good, but with interest rate coming down, the concern with many people is whether they can sustain this record profit. Because of the global Basel III reforms, their CET1 ratio is at 17%, which it still indicates a lot of extra capital. Therefore, with this, they rewarded shareholders with higher dividends at 60 cents per share with additional 15 cents per share for the next 4 quarters. For banks, net income usually comes in 2 areas: interest income and non-interest income. Interest income is dependent on the interest they earn from loaning their money. There can be two-way effects. If the interest rate is higher, they will earn more from the interest payment of the lenders. But if there are lesser people willing to loan, then the income they earn will drop due to lower amounts of loan taken. The truth is the opposite for lower interest rate. So it's not so simple to think that lower interest rate will guarantee lower interest income. It's dependent on how the bank manage those debts, like how DBS were locking in the interest of the loans to ensure that the lower interest rate will not affect them that greatly. Non-interest income can be any income that the bank earns from activities other than their core inventory businesses, such as taking deposits and making loans, or from their investment. Usually, they can be more volatile, but the good thing is that if the interest rate drops, the net income for this section does not get affected as much. So if you look at their net interest income, net interest margin dropped from 2.83% to 2.77%. This is expected with the Fed and the other countries cutting interest rate. However, their total net interest income actually increased from 3,597 million to 3,728 million. This happens because more people are taking on loans, which offsets the drop in the interest margin. This is very good because this proves that even with the interest rate being cut, due to the management's active managing in fixing their loans, they are able to increase their interest income. For this quarter, the non-interest income was not as good, with the income dropping Q over Q from 2,156 million to 1,777 million. One of the drop this quarter was due to the drop in the wealth management. However, it's still a good result if we compare year over year with an increase of 41% for just wealth management alone. This led to lower income Q over Q of 4% while expenses increased by 6%. Profit before allowance is at 11%, and after setting aside some allowance for those non-performing loans, their net property income is lower at 13% year over year. As they have mentioned, due to seasonality, wealth management activity was usually slower in the Q4. Cost to income ratio measures the efficiency of bank operation. The lower the ratio, the better. Due to the drop in the income and the increase in the expenses, this led to higher cost to income ratio for this quarter of 44%. Even though this quarter is higher, if we look at the full financial year, it's still stable at 40%. So we'll have to look closely into the expenses to ensure that it does not increase too much. NPL are non-performing loans which the banks feels that there is a risk of the loans being default. That's why the higher the non-performing ratio, the more riskier the bank is. For DBS, the NPL ratio is stable for the whole year with 1.1%. CET1 ratio is important as they are cash or stocks which banks can easily sell to use in the event if there's a crisis. Tier 1 is the main bulk and should normally be more than 10%. Singapore banks are well above the ratio. DBS this quarter came in at a high value of 17% with additional Tier 1 ratio of 0.7%. This huge increase was thanks to the computation per the Basel III international standards used to calculate the CET1 ratio. This shows how much additional capital that DBS has and is willing to reward shareholders. Because of the large excessive capitals, the management has constantly emphasized on rewarding shareholders by bringing down the excess capital over the next 3 years. I favor this year's special dividend as it is more spread out rather than just giving one large amount. This led to not only increasing the quarterly dividends to 60 cents per share, this financial year of 2025 will have a total additional bonus dividend of 60 cents per share. If we assume the full year financial 2025 to be the same, the dividend will come in to be 300 cents per share, and at the current share price, its dividend yield will be around 6.5%. So what is the outlook for DBS? Continued decline in the net interest margin will be offset by the loan growth. This can be seen from this quarter's results with higher interest rate income even though the net interest margin has dropped. Moreover, they expect more growth in wealth management fees and treasury customer sales. At the current result, I'm optimistic that their income can continue to grow for this coming financial year. Moreover, in the earnings call, they have still mentioned about investing in digital banking, wealth management, and AI to make business more cost efficient for future growth. This may lead to higher ROE in the future. However, one particular concern will be the global minimum tax of 15%. This might be one that threatens DBS profit to be lower for this coming financial year. To me, DBS is still one of the better companies to hold as dividends for the long term. We can continue to monitor closely on their performance. Additionally, inflation result in the United States just came out with slightly higher inflation rate than expected. This will further delay interest rate cuts in Federal Reserve and will definitely benefit banks globally. Therefore, DBS is still very attractive considering the fact that interest rate cut will now be slower and they have been using their excess capital to further invest in their business to make them more efficient. Thank you so much for watching. If you have enjoyed the video so far, please support the channel by hitting the like, subscribe, and comment your thoughts on their earnings. With UOB and OCBC result coming out, you can watch my previous video where I compare on their Q3 results to refresh yourself. There was analysis done on this quarter's results for Mapletree REITs as well. Thank you, and I'll see you in the next video.